Okay, this week's practice on adjusting entries, we will be using an example I have created called Boats R Us. Here are the 6 adjusting entries that I have for us to do, and all we're going to do here is prepare the journal entries, post them to the T accounts, and then prepare an adjusted trial balance. So if you want to pause the video and just quickly jot these down, if you don't have access to our Blackboard class, I would do that. There's not a lot here. And then here are the opening balances that we will keep referring back to complete these journal entries, these adjusting journal entries. You can see here at the top, I always like to make sure if I'm starting out with pre-given numbers that the accounting equation equals, because if it doesn't equal when you start, it sure isn't going to equal when you're done. So the assets, when I add up all of my debits of the assets and subtract out any contra accounts like the accumulated depreciation, I got $17,400, and then the liabilities, owner's equity, revenue, and expenses did total here $17,400 when I combined all of them. So I know I'm starting out equaling. Here's a quick look at some of the accounts we're going to be using that are and what I want to draw your attention to. Notice there's just one number on each one, and I'm pretending that that's our final December 31 number before adjusting entries. So we would have had maybe 20 different numbers here in cash, but this is our final number before any adjustments. We have our account receivable. We got some expenses over here. And then towards the bottom, we've got a couple of prepaids. You can see our supplies. And then the final items down here are our long-term assets, the equipment, and $1,000 in the accumulated depreciation. Okay. So now what we're going to do is look back here at journal entry number 1, or the transaction that I need to journalize as an adjusting journal entry. So here it's telling us our piece of equipment, it has a useful life of 10 years. That's the equipment we just looked at. And this is the 2nd year of the equipment's life. You may look at this initially and think, I don't know how I could ever do this, since it doesn't have any amounts there. It doesn't tell me what the equipment's worth. But we can easily look back to our opening balances down towards the bottom, and the equipment has a balance of $10,000. Well, if I take that $10,000 and divide it over 10 years, its useful life, that gives me $1,000 per year. Well, notice I already have $1,000 here in the accumulated depreciation box. You think, well, I don't need to do anything. That $1,000's already there. Well, remember, it told us that this was the 2nd year. This was the 2nd year of the equipment's life. So therefore, that $1,000, that was from last year, and it got carried over. This year, I'm going to need to add a new account. I'm going to need to add some additional information, some additional totals. All right, so when we use our equipment, we need to do an adjusting entry. And remember back from our lesson, that was called depreciation expense. I'm expensing out that $10,000 asset a little bit every year for 10 years. And so I depreciated it $1,000. So I'm going to come down here and notice I needed to start a new depreciation T account. I didn't have one to start with. And that's because, if you remember back to a previous example we had done, just real briefly, I'm going to talk about this, but then we're going to cover this more in the following week. Any revenue or expense accounts at the end of the year get closed out to 0, and they will eventually end up over in owner's equity in an account called retained earnings. So last year's depreciation expense of $1,000 was wiped off and put over into retained earnings as one final number. So this year, depreciation expense didn't have anything yet. So this was my first entry into the depreciation expense for year 2 of the equipment. And then anything besides revenue and expenses, they keep their balance. Just like if you have $1,000 of cash at the end of the year, at the beginning of next year, you're still going to have that $1,000 of cash. So that's why those accounts don't reset. And like equipment, if I still have $10,000 last year, I'm still going to have $10,000 at the beginning of this year. Well, when we added $1,000 to this year's depreciation that we used, I need to add another $1,000 to my accumulated depreciation for the equipment. This is now showing me, the key word here being accumulated, that I have accumulated $2,000 worth of depreciation over the equipment's life. And if one of the things that I asked you then was, well, what's the book value of the equipment? What's it worth on my books after year 2? We could easily do the net here of $10,000 less the $2,000 that I have depreciated. And the equipment is still valued at $8,000 on my books. That doesn't mean that's what it's worth in real life, fair market value, but that's what it's worth on my books. So that's an example of how we do our depreciation. Now, the one last thing that I wanted to comment on accumulated depreciation, this is a contra account. So it's backwards from my equipment. Equipment's plus minus, advertising plus minus, or prepaid advertising. My accumulated depreciation is a minus plus. So even though I'm increasing this particular account, overall that $2,000 takes away from my overall assets when I'm ready to add up my and get totals for the parent accounts. That's going to take away. All right, my second entry, adjusting entry, says I had wages accrued but not paid of $2,000. Well, let's take out the word accrued and put in layman terms what that means. So you could also say this: wages, my workers have done work, because remember accrued means work's done, but no payment yet. So my workers have done work, but I haven't paid them yet as of the end of the year. Now, if work has been done, I need to show that as a journal entry even though cash hasn't been paid. So I'm going to think, what did the business get? We got the use of my workers working, so that's a wage expense. That's a benefit to the company. And why do my workers work? Well, they usually work for cash, but in this case I haven't quite paid them yet, so I owe them. And we call that a wages payable, or abbreviated WP, wages payable. So my workers have worked $1,000, so I'm going to add to my expense. I already had $4,000 in my expenses. Now I'm adding another $2,000 for this pay period. So now my total wages that have been worked for this year is $6,000. And I'm going to come over to the liabilities, add a new account. I haven't had a wages payable yet. I didn't have a balance in there. But now I owe my workers $2,000. So I'm going to credit my liability account. My third entry, services performed for Sally are complete. Well, initially you'll look at this and think, well, okay, that's nice to know, but how much did I owe Sally? Well, that's again where I'm going to want to look at my opening balances. And I got to think, what account is going to show me that I owe Sally a service? Well, if I owe anybody anything, it's under the liabilities. So I need to look down the liabilities, and here I see an unearned revenue. I owe Sally a job. She has paid me, but I just haven't done it yet. And this shows that I owe Sally $2,000 worth of a service. So she had originally paid me ahead of time, and I'm counting it as an unearned revenue. But now, as of the end of December, I have completed the work for Sally. So I don't want this $2,000 here anymore. I want it to show zero, because what the business gets, they got a reduction on my balance that I owe Sally. And I have a reduction on the balance because I've now completed the work, which would be a revenue. So when I look at the third journal entry, that's my third adjusting entry, I need to debit my unearned revenue because I no longer owe Sally any money. So that gives me a total of zero now. And I need to then transfer that $2,000 over here into my service revenue. So I'm increasing my revenue account by another $2,000 because that job is now complete. I combined for my answers here number 4 and number 5 because they're very similar. Prepaid rent was used this month, and I calculated that it was $500 of rent was used. And then the entire prepaid advertising was used. So whatever I had in prepaid was gone, is now gone, and whatever I had in rent is $500 is gone. So let's look at my opening balances for both of the prepaid accounts. So I had prepaid rent valued at $1,000. I've now used $500 of that. And my prepaid advertising was at $500, and it tells me I've used all of it. So now I've got to go through, let's do one at a time. What did the business get when we used $500 of our rent? Well, I got a benefit. I got the use of getting a property for a month. So I'm going to put that into rent expense and then take it away from my prepaid rent because I no longer have $1,000 in prepaid rent. I really only have $500 left because I used $500. Same with advertising. I started with $500, but now I actually got the use of that advertising. The business has benefited. So I'm going to debit my expense account to show that I got a benefit. And then I'm going to credit my prepaid advertising because I no longer have any prepaid advertising. So here's what the journal entry is going to look like. Debit my rent expense, as I said, credit that prepaid asset account, prepaid rent. Do the same thing with the advertising. So let's see how that looks here on the T accounts now. So the first thing I did was debited my rent expense. I already had a rent expense category. I'm just adding to it. And then I'm taking that $500 out of my prepaid rent, leaving only $500 balance left. Advertising, I didn't have one of those yet, so I needed to create a new advertising expense T account. Call it account 504, just the next one in line. I added $500 to that expense because my prepaid was completely used. I no longer have any advertising ready to be used. It's now, I've paid for it and now I've gotten the benefit of it. So my advertising prepaid is down to 0. All right, my last adjusting entry before I need to go ahead and do the adjusted trial balance. My last entry says I went back and I counted my supplies, and of whatever I had to start with, I only have 300 left. Okay, well that gives me a start here if I only have 300 left, but I need to, now notice that's what I have remaining. That's not what I used. So don't just rush and put 300 as my journal entry. That's what I have left. So to know how much I used, I've got to know what did I start with. When I look at my assets, I see in my supplies that I have $900 starting out of supplies. When I'm all done at the end of the year, I only have $300 left. So obviously I've gotten rid of $600 of supplies. I've now gotten the benefit of using that. So that's considered a supply expense as my debit, and then come over here and credit the supplies that are no longer there. So that's what I did here in number 6. Debited my supply expense, add $600 to what was already there, and then credit my supply account to show that that 900 isn't really 900 anymore. I'm really at 300, what's left, what I actually counted. Now, like any T account journal entry things that we've done, we always want to go through and total when we're all done, total every one of our T accounts. Here's a couple that I have done. I did the revenue, I did the supply expense. And then our second step, what we always want to do is add up all of our assets. So I've added up all of the assets, and then I subtracted out, of course. I have to always subtract out any contra accounts. This one I subtracted. The accumulated depreciation. And so when I did all that, I got my assets to be $14,800. My liabilities, I looked down. Sears, I still owe money to. However, Sally, I don't owe anything, so that count's been wiped out. That's 0. I now owe my workers $2,000, so that's where the $5,000 comes from, 2 plus the 3. Nothing changed with my capital. My revenue did go up a little bit to $14,000. And then all of my expenses, when you add up every one of them, I think there's 5 of them, you get $11,600. When you combine 5,000 plus 74 plus 14,000 minus 11,600, I do total my assets of $14,800. Now the final step in this process is to go ahead and now prepare our trial balance. We call it, though, an adjusted trial balance because it's probably the last one we're going to do for this time period, whether it's the end of the month, the end of the quarter, or the end of the year. I'll need to probably note that, but for whatever time period we're doing, this is our final trial balance. And so like any other trial balance, we always have our company name, and then we have what we are preparing. In this case, it's an adjusted trial balance. That means our adjusted entries are now included. And then the date, whatever time frame it is that we're working on. Maybe it's at the end of March. Every month we do one. So we would put as of March 31. And then finally, the trial balance itself isn't very hard to prepare. All you've got to do is look back to your most current balances of each account that you still have open. So cash didn't change, but like if you notice, prepaid rent is now only $500 instead of what it was, $1,000. Notice there is no prepaid advertising, because if we look back, prepaid advertising was completely used up. We have a zero balance. It doesn't even need to go on our trial balance anymore. It's zero. We don't put any zero accounts. Remember, supplies went down. We used some. My accumulated depreciation went up because I have used my equipment. But notice the actual price of the equipment didn't change. The unearned revenue to Sally is gone, but I did get another one in its place, the wages payable. And then I've got a couple of new expenses as well that I needed to add on. So remember, the whole purpose of doing trial balance, there's 2 reasons. One is to have all of our accounts in nice, neat order, assets all the way down to expenses, and with their final ending balance. And then the second reason to always do a trial balance is to make sure our debits equal our credits. And that can help us know that we've done everything correctly, along with having the accounting equation balanced. If you found this helpful, please go ahead and like it here on YouTube. Make a comment. I really like reading those. It helps encourage me to continue to make these videos. I hope they are beneficial. And we will look at another example, and then we will move into closing entries in our next lesson.